Good afternoon, everyone, and welcome to Q2 FY23 earnings conference call of InfoBeans Technologies Limited. And now I hand over call to Radhika for the formal introduction. Over to you, Radhika.
Good afternoon, ladies and gentlemen. Welcome everyone to the Q2 earnings calls of InfoBeans Technologies Limited. The results have been sent to you and mailed to you, and in case anyone is not having the copy of the same, please write to us and we'll be happy to provide you the same. To take us through the results of this quarter and answer your questions, we have today Mr. Avinash Sethi, co-founder of InfoBeans. We will be starting the call with brief overview of the company's performance, and then we will follow with Q&A session. Kindly ask your questions by raising hands, and once the brief overview by Avinash is over, and then we will address every question one by one. I would like to remind you all that everything said on this call that reflects any outlook for the future, which can be construed as a forward-looking statement, must be viewed in conjunction with uncertainties and risks that we face. With that said, I will now turn over the call to Mr. Avinash Sethi. To you, Mr. Avinash.
Thank you, Radhika. Thank you everybody for joining this call and your continued support for InfoBeans. We appreciate that. Let's look at the quarterly numbers. Let's go to the next slide, please. Is everybody able to see the screen, I believe?
Yeah.
Yes, we are able to see.
Yeah, they are able to see.
They are able to see. Okay. Let's go to the next slide, please. So essentially, we have grown fairly well in terms of the revenue numbers. The revenue number is about 102 crores. Is shared and uploaded on NSE website as well. We have grown slightly further. So if you look at the H1 numbers on the screen, at a glance, we talk about 200 crores of revenue on the H1 side, as compared to about 120 crores in the H2. We have generated about 46 crores of EBITDA, 22 crores in PAT, and we have about 153 crores.
This meeting is being recorded.
And cash equivalent, which includes account receivables. Interestingly, I want to highlight this point here that we have grown on a YOY basis. If I compare H1 of last year versus H1 of this year, it's a 66% of growth, which is phenomenal. It's a combination of organic and inorganic, which is a testament to our strategy of growing the business at a faster pace using both the tools, organic and inorganic tools. So very happy and very glad to tell you that we are on the right track, and we want to grow the business at a faster pace than the rest of the industry. Today we are a team of 1,625 members. We have crossed 1,700 in this quarter, but we have also curtailed back. There is an increasing list of Fortune 500 clients and an increasing list of active unicorn clients that we are working with. There is a partnership and several awards that we receive every quarter and so. Next, please. This is a quick transformation over the years we have talked about in several calls, so I'll skip this. Next, please. Again, the senior leadership here, the board of directors, and next. And the very experienced and dependable team, these are the three of them are founders, Jitendra, Emerson, and Shreyas from the acquired companies. Dennis is a recent joinee. She is now heading design and innovation as an SVP from the US team. Next. This continues. Darshana, we talked about last time. She has joined us as a blockchain evangelist, as a VP, and we are building and investing in this new practice. Again, a very senior leadership out there. This is a quick chart of growth, from FY17 to FY22. In 5 years, we have grown from 84 crores to 29 crores, and this H1 is about 200 crores already. So we are on the right track. We keep cautioning about the margins on the EBITDA and PAT side, that the 28-29% which we saw last 2 years is not sustainable. and we'll come back to 24% kind of a margin that we want to preserve and sustain going forward. Around PAT is 14-15% margin that we want to sustain. We are dipping on this right now, but as we keep mentioning that we are investing in our growth, we have shown 66% growth on the H1 side. So it is really working for us. We have seen our clients staying with us over a long tenure. So it is an important strategy for us to capture the business first, establish those relationships, and then build upon it. The PAT margins will quickly recover moving forward. But the strategy is working is what I think we can see here. Next, please. So comparison between Q-on-Q and YOY for the September quarter, 102 crores in revenue. It was 98 last quarter. It was 65 a year ago. EBITDA, a slight dip here from 24 to 23. And then an increase of 37% from 16 to 23 from the last year. PAT has shown a little bit of a drop from 12 to 10 for both the quarters. But if you look at it in USD terms, we have grown 64%, which is a significant growth that we see on a YY basis. Next, please. So here, this is the H1 comparison. So on 108 crores that we did in the first half of the last year, we have done 200 crores. It is a 66% jump. I think the USD numbers are reversed. It should be 66% here in this slide and 58% in the previous slide. Next, please. On the geography breakup, India has come up as a larger geography for us. UAE and Europe contributes. Europe and UAE both are growing, 6% and 7%, and 72% is US, which is shrinking as compared to what it was previously, which is, I would say, good and bad news. Good news is that we are spreading in more geographies that we intended to. Bad news is that dollar is the strongest of the currencies at this point in time. From a segment point of view, we are 50-50 more or less. On the business side, InfoBeans Cloud Tech, which is the new name for Eternal Solutions, is doing about 19% of the total revenue for us, and InfoBeans does 81% of the total. Next, please. So, very good news here is that the blockchain technology investment that we were doing, we already got a project from a client which is LA-based, Los Angeles-based client, which is into selling and preserving of art. They are going to use NFT to fractionalize those pieces of art and sell in the market and generate revenue out of it. So we have grabbed that project, which is going to help the blockchain practice. So this is a significant win. This is an interesting story of another client where we expanded our capabilities and generated more business from there. So the design team based out of the US is working with us together, where the design part will be done in the US and the development part will be done in India. So this is the synergy between philosophy team and India team that we are exploiting at this point in time. So it's showing up. We are adding more large names into our bucket as our customers, and we are, as compared to 6 companies in the month of March quarter, in the March quarter, we now have 11 in our kitty right now. So again, the strategy to focus on the large customers is playing out fairly well and gives us a lot of strength in these turmoil times, where we can rely on repeat revenues from these large customers. InfoBeans is a common brand that is going to exist and apply to all the acquired companies that we have. And Eternal's name is changed, and philosophy is also now under InfoBeans as a common brand. Another good news is on 10th of November, we'll be in Mumbai to get the BSE listing activated for us, and it will be done with the hands of Honorable Chief Minister of MP in the Hotel Taj President Cup Parade in Mumbai. So I invite each one of you to participate, be there in person, and we'd be love to host you. I think the timing is about 11:30 to 12:30, followed by lunch. So please join us. Me and Siddharth and our independent director, Mr. Santosh Mochal, will be there. So I will be happy to host you and welcome you for a quick one-on-one interaction also, and be part of this historic BSE listing for us. We have added a new office in Baner in Pune, which is a 500 seating capacity. We are quite hopeful that the team is now coming back to office, and we are quite hopeful that with this new facility we'll be able to expand and enhance our presence in Pune. We are already, so we, those who are not aware, we have 2 offices now in Pune, and we are probably 700+ people team in Pune alone. So pretty good strength there. Next, please. Some of the clients, that we keep talking about, ALM is a client with us for 19 years, IQVIA for about 12 odd years. Meta is, philosophy client for 4 or 5 years now. West Management is a recent client, TripAdvisor is a recent client, and there are some of the names that I can't mention. But yeah, they are good clients, Fortune 500 companies, and they established relationship with us. So very happy and proud to have these names in our roster. Next, please. So we keep repeating this point that we want to scale the business through both organic and inorganic pieces. We continue to invest in our outbound sales efforts in all the geographies that we have. We have physical presence and physical offices in all the 3, overseas locations: US, Germany, and Middle East. We have physical offices and physical team members there. We continue to expand in those geographies, and we also continue to expand in our existing clients by way of a client success function that we have. We are leveraging 2 strong partnerships that we carry. One is the Salesforce Platinum partnership that we have. And interestingly, now we are Salesforce. We are co-selling with Salesforce in US and UAE as well, which means that Salesforce is helping us generate more and more business for our services, and that's a very strong endorsement and of our capabilities, and enhances our credibility in front of our customer. So we are very hopeful that we'll be able to generate a much stronger pipeline through Salesforce as a channel partner. ServiceNow is another partnership that allows us to go inside large companies because, it is both these platforms are being used by large companies with a large budget for the IT services. And therefore, it is a very strong, unique strategy for us to penetrate our customers using these kind of capabilities. We are also investing in R&D on the blockchain that we talked about. And we still focus on North American market as a key market for us because 70% plus revenue comes from that market. Now, having said that, we are also investing in the inorganic piece. Currently, the environment is good. We get about 6 to 7 deals every month, and we are discussing and debating on these opportunities. So the deal flow is good. The pipeline is in the areas that we are looking at. So as and when there is a progress, we'll certainly announce it. But we are happy with the current traction on this particular process. We are focusing on areas in terms of the data analytics companies, in terms of the machine learning companies, or Salesforce and ServiceNow kind of companies. We are looking at US-based geographies more prominently because that is a market that we like and understand. We also want companies which has penetration or which has presence on the enterprise clients. We don't want companies with a long list of clients and a very tiny revenue share from each one of them. We want to work with companies, or we want to acquire companies which work with clients, less number of clients, and have deeper and larger relationships with each other. Next, please. So this is the story we keep talking about. We want to grow ourselves, at a pace where we can at least double ourselves every 3 years. We've been doing it since 2010. Here is a summary of last 5 years. And if you look at those dotted lines, we have doubled ourselves from 1 year to another year using those. You can trace it through those dotted lines. The next year, FY23 is also in line. We are already doing much better from 289 to 400 crores. So in fact, we'll probably look at doubling ourselves from FY21 to FY23, doubling ourselves in 2 years rather than 3 years this time. We've been showing that kind of a CAGR for the last 5 years in all the key matrices like revenue, EBITDA, PAT, and net worth. We are a debt-free company, good cash and cash equivalent, and it includes account receivables. There's a $14 million pipeline with a fair confidence for the next 12 months. We have successfully executed organic and inorganic growth strategies, as I mentioned at the start of the presentation. High H1 revenue growth at 66%, here it is a mistake here. And then a highly committed and focused team with a large stake in the company. So the 3 founders have about 75% stake in the company. And, we have a very high skin in the game in terms of growing this business aggressively. We participated in the Dreamforce, which is the event for Salesforce companies. And we got a very good traction from there. Salesforce announced a new module, a new capability of loyalty management, loyalty management as a module. And incidentally, we were able to, they just released it in Dreamforce, which was in October. And we were able to sell that capability to one of our customers in the US. And we are currently implementing along with Salesforce here. So very strong partnership, leverage that we are doing here. And since they come up with this new model very, very recently, we are actually going ahead and implementing it, which can give us a very impressive head start in the market. What we did was the Salesforce enthusiasts in our office actually decorated our office in the theme of Dreamforce also. So, some pictures there. Next, please. We are also investing in terms of building the local community for Salesforce and ServiceNow. And we are acting as an evangelist in the Central India market, where we are bringing in all the developers on Salesforce or ServiceNow together in our office and doing learning sessions with them. So there's a large community showing up on Salesforce, and ServiceNow is also building up. So interesting startup of new, I would say, community building exercise that we're doing. We'll extend it to more geographies like Pune and Chennai. But yeah, this is a good start for us. Next, please. Glimpses of the new office in Pune. It is in a iconic building of Pune where Symantec and Veritas used to function. The name of the building is Icon 45, and it is a Brookfield property. So we have, we had this inauguration done in the month of October, very recently. On the CSR side, we've been planting trees on the roads, and the roads are concretized, and we are planting it on drums that you can see in the pictures. And we are also doing computer training programs, both short-term and long-term. Short-term is like 1 month, 2 month kind of programs. And long-term is a year-long program where we make them job ready. And we have 3 batches in 3 years, very, very successful batches. About 80 odd students got placed in the various companies in Indore. And we are very, next please. We are very hopeful of, taking this further. This is the 3rd center that we opened up for our InfoBeans Foundation in Indore. And this have a capacity of about 80 odd students that we can train at a single go. So on the next shows the detailed financial analysis here. Next, please. Where we talk about the quarter numbers and actual numbers. The presentations have been shared, I believe. You can have a look at that. Let's just go back, please. I think just a point here that, our EBITDA margins have come from, 25% to 22% from September 21 to September 22. This is, anticipated. This is a known evil that we are investing in our growth. We are willing to capture the market, the revenue first, and hiring people at a higher cost. We know that we are paying very, very handsomely, but we are also very, very aware, and we are working on already that we are increasing our rates. We are passing the cost to the customer. We are improving our utilization levels. We are investing in our team in terms of cross-skilling and upskilling so that we can, optimize and get better margins. We are also aware that, since we have been able to build long-term relationships with the customer, we'll be able to recover these lost margins in future. The PAT margins, we have dropped from 18% to 10%. 18% was an anomaly. 10% is also not really a comfort factor. We would want to bring it back to 14-15% kind of a number, and EBITDA would want to bring it back to 24 kind of a number. I think we are fairly placed in terms of revenue growth that you can see year-over-year, and we'll be able to recover these margins in probably the next 3 to 4 quarters. Next, please. Yeah, this is the audited balance sheets. I'll just skip it. Next, please. Thank you very much. I think we can now open up to question and answers. I know that a lot of questions keep coming, and we always fall short of time. So let's jump onto the question and answers right away.
Thank you, Avinash. So ladies and gentlemen, those who want to ask the question, they can raise their hand, and then we'll allow them to ask the question.
So we can begin with Rajesh Chaudhary. We can actually go by the sequence, but yeah.
Hello.
Yeah.
Hello. Are you able to hear me?
Yes, Rajesh.
Yeah, Rajesh.
Yeah, good evening. My question is can we expect a 20% CAGR in revenues and 25% CAGR in profits, say, for the next 5 years without any further organic growth, since we have an aspiration to double our revenues every 3 years? Can we do it without any inorganic growth?
Rajesh, there is no question of without or with or without. If I were to look at past historical data, InfoBeans has been growing. So let me split it in two buckets. Between 2010 to 2022, we have grown at an organic pace of forget about the word organic. We have grown at a pace of 35% plus.
Yeah.
CAGR. Okay. Between 2010 to 2019, it was purely organic. We acquired our first company in 2019.
Okay.
And the second company was acquired in 2021. Okay. So if you look at September 22 and September 21, the organic growth alone is 40%.
Okay. No, so my question is we can still maintain this run rate, no? Because since now we would be on a higher base as compared to 2010.
Hey, Rajesh, we are investing in growth. That is what I'm saying, that we are investing in growth. And even in the turmoil time, so this last 2 years have been tough for IT companies, not because of revenue, but because of cost.
Yeah.
Right? And we have taken that call that we will, continue to hire people even if we have to pay a higher cost. So we are compromising on the margins, knowing fully aware that we are doing it because we want to capture the market. We want to capture the relationships with the large companies. We want to boost our revenue first, and margin will follow. So we are confident that we are on the right track, and we should be able to, maintain the current pace that we have been doing it for last 5 years or for last 10 years. We
So
would want to maintain that.
in terms of like profit margins, can we expect a net profit margin of say 15 to 17%?
See, net profit margin is not a big worry that I would bother about. I would really bother about EBITDA margin is the first thing. Because PAT margins vary because of various other things, right? Because of depreciations, because of
the taxes and
a lot of other things. But despite that, as I keep mentioning, we would focus on 24% EBITDA margins and 14 to 15% PAT margin. That is our goal. Now, can we achieve it next quarter? Can we achieve it 4 quarters from now? I can't answer that. We are working towards it, and we will achieve it. When it is going to be, I can't really.
No, if somebody has a say vision of say 4 or 5 years, I think we can do that. I think.
Oh, 5 years, absolutely yes.
Not couple of quarters, like at least for say couple of years, 3, 4 years.
Oh yeah. We should be bringing it back sooner than that.
Okay. And another question is like, how much percentage of the revenue are we getting from Europe? I skipped that. I think
7%.
7%. So, do you foresee any impact of the war in our business from Europe?
It is actually helping us in a sense that we'll get more business. The work that is not been done by Ukraine and the Russian geography or nearby geographies, will spill over to India.
Okay,
we've not seen anything
as we have heard from the very various media reports, like Europe is going through a recession and there would be a lot of uncertainty in terms of the business. So, do we foresee
a very small component? We don't have to worry.
No, in terms of like say today it is 7%. My question is like, can we scale it up in spite of the recession?
We've been trying to scale it up, and earlier it was 5%. It has come to 7 now.
Okay.
But then Indian geography has come up. So.
But otherwise, you don't see any major impact.
We don't see any.
Okay. And lastly, like as I understand, we don't hedge our currency. So how do we take care of? We do hedge our currency. Okay.
Yeah, we do hedge our currency.
Okay. And what would be the attrition rate for this quarter?
It is under 5%.
It is under
5%.
And
so
for the
annually it is 20%, under 20%.
It is under 20%. I think last time it was more than 25%. Now it is less than 20%.
Yeah.
Okay, great.
Thank you.
Okay, thank you very much for your time. Thank you.
Thank you, Rajesh. So the next question comes from Devavrat. Devavrat, you can unmute yourself.
Hello, Avinash ji.
Hi, Devavrat. How are you?
I'm good. Fantastic numbers. I must say I'm very, very impressed with the numbers. So, I mean, I was just wanting to, clarify a couple of things. The other income that was there, the YOY component would be the loan write back that we got back from the government, US government?
Yeah.
Right?
So if I look at purely the income from the operations, the growth is much higher.
Exactly. Yeah. Right. Yeah. So you've actually done quite well. And wanted to ask, sorry I joined the call late, but just wanted to ask how your latest acquisition is doing.
It is wonderful. I mean, it is helping us boost our margins.
Okay, that's good to hear. and sir, one more question I had was that in your acquisition pipeline currently, because you said that you might want to be looking at acquiring a few more companies going forward. So, do you have anything in your pipeline right now, like where you might be going for an acquisition anytime soon?
So we continue to do that even right after Eternal's acquisition, which was like October last year. We were evaluating companies, and we actually gave 2 term sheets in between then and today. and it didn't consummate. They didn't sign it. So we gave an offer, they didn't sign it.
Right.
Or we didn't announce it to the public.
Right.
So we are constantly working in that process. And it's not that we've stopped even right after the acquisition also, we were evaluating companies.
Right.
It is a very important piece in the entire equation. And therefore, I get upset when people ask as to, without inorganic growth or without organic growth. And I don't understand that mechanics. As a business, we are investing our time, money, and sweat and energy in doing both organic and inorganic piece. So it is very hard for me to differentiate and say, okay, this is not going to happen. This is going to happen. Okay, let me imagine this. It doesn't make sense to me at all. But as a company, we are focused on, as a core strategy, both organic and inorganic. And we continue to invest. And if you look at that slide of organic and inorganic, that remains same for all these 5.5 years.
Absolutely, sir.
So we are not going to change our ways. We are going to focus in that same direction. And we are seeing the results. It's working out so well. So why would we drop one over the other?
No. Agreed. And sir, what is the status? Where do you see attrition headed now? For you guys?
I think, ironically, good news is attrition is low.
Right.
But at the same time, we are also seeing that because we work in specialized pockets of Salesforce, ServiceNow, and automation space, we are finding it tough to hire people. It is equally tough as it was 6 months ago.
No, but is this because of lack of talent in the market, or?
No, I think what has happened is the specialized skills are still under pressure. The scarcity is still there for the specialized ones. But for the generic ones, the pressure is off.
Okay, understood.
So the space that we are operating in, where we have demand, we are seeing a lot of pressure still. But the good news is the attrition is fallen off. So at least we don't have to worry about that part of the piece. Of the puzzle. We are only, at least we are left with worrying about the hiring piece.
So if you're at say 20%, you're comfortable with those levels, like you're okay with that.
It is pre-COVID levels kind of a number. So 15 to 20% is the normal range, any point of the time for IT industry. So we are back to that normal range.
Okay, sir. Well, that's it from my side. Thank you so much.
Thank you, David. Next question comes from the line of Anika Mittal. Anika, you can unmute yourself.
Hello. Good evening, sir.
Good evening.
Sir, my question is, we have been able to grow our top line by 80% in half year financial year 23 YMY, which is definitely a good sign. But sir, I wish to highlight 2-3 points for the bottom line. First is the tax rates. Consolidated tax rates on profit before tax in FY22, it was only 9%. See, and in Q1 and Q2 of FY23, it increased to 18%, 23% respectively on consolidated number. Then second is the interest cost, sir. FY22, it was 4.61 CR, and it's in half year, it's already 4.08 CR, sir. I agree that due to acquisition, we had to leverage on, but it's eating up our bottom line significantly. And lastly, on the depreciation side, that is almost double, sir, in September quarter last year, for more than 7 quarters in both the quarters. So I understand you have grown top line, but the proportion of increase in top line is significantly lower than increase in depreciation. So ultimately, due to acquisition, I agree we are growing our top line, but we are ruining our bottom line, sir. So what is the benefit, and how long after how long time we can see the results coming in our bottom line due to these acquisitions going on, sir?
So if you're talking about finance cost, there is no interest. We don't have any debt. If you're talking about finance cost, this is purely the interest.
Interest on lease, notional interest on lease.
So it is an accounting entry because of the notional interest on lease, which we have signed up for all the offices that we have. So I don't think it is negative in a sense, because it is rental cost essentially. And we are not. So to answer your question, we're not taking any debt or acquiring companies, using our own cash flows, and the acquired companies generate their own cash flows, which, supports the future earn-outs. That is one part of it. The other part you asked about the tax rates. So the tax rates are increasing.
We have substantial profits from a tax-free entity.
So what has happened is, InfoBeans is in SEC. So the bulk of the business that we have, is under MAT, which is 15% tax rate. But because of Eternus, which is a fully taxable entity, the tax rates are increasing every quarter now. So, and they are making more profits, so obviously the tax rates are going to increase for them. So essentially at a console level, that is where the tax cost is increasing.
So what is your guidance for the tax rates going forward now on consolidated basis?
I would say this is the number that we can look, this is a percentage that we can look at moving forward.
The 23%.
Yes.
Not at a console level, it's not be 23%.
Yes.
At console level. Okay, so my finance head suggests that it is going to be 23%.
Going forward, right? 23%.
Yeah.
And so how we are going to improve bottom line, because these three items are significantly eating up our profits, and even if we improve our EBITDA margins, as you are saying,
to improve the bottom line, we have to increase the revenue.
You have to increase the revenue. That's I understand. Means
see,
ultimately
I can't go.
You are getting, but I think you know what I'm trying to ask actually. Means you are getting the top line. I have no problem with that. But ultimately, bottom line is also necessary, because if we are doing the acquisition, that means we are also expecting the bottom line as well.
No, it
so
is.
That's my.
No, so Eternus is helping our bottom line. That's one. Second is, it is with the same team we can generate more revenue. So that needs to be done. I mean, I know revenue is one of the biggest, I would say, savior if we are able to generate more revenue with the same team, which is a possibility, which is a fair possibility. And I talked about in my discussions earlier that we are passing the cost to the customer. We are trying to optimize it. We are trying to put in low cost folks, train them and then move up the value chain. So we are working on each of those factors, but it is a gradual process. It will take time.
And so, as per you, next 3 to 4 quarters, you will be able to achieve that earlier OPM of 24% that you were guiding, and NPM of 14 to 15%. Am I right?
I'm hoping for that. If not 4, then definitely in 8. I can't really pinpoint a particular range, but yeah, sooner is what I would say. We want to do it as fast as we can.
Okay, sir. That's from my side, sir. Thank you.
Thank you.
Thank you, Anika. So the next question comes from the line of VP Rajesh. VP, I have unmuted him. You can go ahead.
Thank you. Hi, Avinash. Good to connect again, and congratulations.
Thank you.
So first question, if you can just segregate the year-over-year growth between organic and inorganic, that would be helpful.
See, I think if we go back to the quarterly numbers, please. Is the screen shared?
No, not yet.
I can give you some number off my head. So if I look at let's say compare September 21 to September 22, right?
Right.
So if I look at revenue from operations, 57 crores is purely organic in September 21.
Correct.
September 22, we got Eternus numbers also, which is about 19 crores.
Oh, so I see. Okay.
So 81 on 57 is the organic growth.
Got it. Oh, wow. That's fantastic.
That's what I'm saying. I mean, we have been growing organically because of the investment that we did, and it is showing up, which is much faster than, the peer companies.
Got it. And then second question, Avinash, on the margin side, do you think it has bottomed out at 21%, or you are anticipating making more investments in the coming quarters so that potentially it can go lower? What's sort of the sense you have?
I think we are already on track in terms of whatever we were supposed to do. We have already done that. So more or less we are there. We should be, increasing from here moving forward. With one exception, which I mentioned last time also. In the March 23 quarter, we'll have the retention bonus coming in, which was given in last year, where we wanted to retain people on a 18-month horizon. Which the expiry of that happens in March 23. So that will be a one-time hit that will happen. But as I said, there are the tricks that we have to apply in order to retain and maintain that kind of growth. So we have done those kind of things.
Got it. And can you quantify that number of that retention bonuses?
It is difficult because, we are trying again more ideas around it. One is that we would, possibly want to convert that into some kind of equity if at all that happens. There are people that leave in between, so numbers reduce.
Right.
So it is, still I don't want to, quantify it at this point in time because it is a wide range.
Sure. Understood. And then on the customer side, Meta is obviously one of our large clients, and given what is happening in their business, and I'm sure you paid attention to their earnings call. Are you concerned that the business from clients like those, and I don't mean Meta per se, but clients like those may reduce business towards us? I mean, how should one think about that?
No, it is happening. So I think what has happened is the world is getting cautious all over again. And so let me make another statement that insanity factor that we used to see in last 24 months, insanity in terms of demand, insanity in terms of supply of people, talent, insanity in terms of the minting of unicorns around us, insanity of the free capital. I think all of that is died. All of that is gone, and we are back to normal world, if I may call that. Because of these inflationary pressures world over in the US and European geographies, plus the timing of the year, October, November, December is a bad or is a lean period for IT industry because of festivals and because of budgetary, exhaustion. So people don't issue any new budgets in this quarter. There is a Thanksgiving, there is Christmas, there is Dussehra, there is Diwali, Navrat. I mean, all of these factors reduce your working days, and people don't come out with new budgets. So nothing new shows up. So demand kind of takes a backseat at this point in time, but it comes back again. So it is a normal scenario. It happens all the time. Only exception was last year when December was also a very healthy quarter. But December would be a lean quarter, which is the normal case. And we are seeing it right now where some clients are holding on projects and they're waiting for new budgets to be allocated, which will, show up in the next quarter or January quarter.
Right.
So I think it is a normal scene. The macro factors usually don't affect the micro companies like us. And whatsoever, historically in last 25 years of my IT career, I've seen that any crisis, any inflation, any recession, any pandemic kind of situation, they've always boosted the Indian IT services business. So I don't think we have anything to worry at this point.
Understood. Great. Thank you, and all the best for your BSc listing.
Thank you. Yeah. Please do join us.
We'll try. Thanks.
Yeah.
Thank you, VP. The next question comes from the line of Archit Singhal. Archit, you can unmute yourself.
Yeah. Hi, thanks. Hi, Avinash and team. Few questions. Avinash, firstly on growth. So there has been a slowdown on a quarter-on-quarter basis, and I do understand the global environment. So has the slowdown been only driven by the global environment, or was there some other reason which led to the quarter-on-quarter dip in revenue? I mean, not dip, but 3% growth, but which was lower than historical times.
Avinash, you are on mute. Avinash, yeah. Avinash, you can go ahead, I think. Yeah.
Okay. So some of the clients are getting cautious, and either there is a project closure and they are waiting for new work, so there is a wait time. Then there is a situation where some of the unicorns that we've been working with have shown some kind of a restraint. Then there are I would say clients where we were hoping for more work, but they've stalled the projects. There are actually two of them who have stalled the projects. So as I said, it is just the cautious approach. We are very sure it will come back, and we'll continue to move from here. So I think it is okay to have a breather in one of the quarters. So I'm not really worried as such.
Sure. And is it possible to mention what was the constant currency growth this quarter, maybe on a quarter-on-quarter basis?
Yeah, I think it is 1%. It is 1% on the dollar terms.
Noted. So Avinash, I mean, I understand the October to December quarter also I will be having furloughs and all, but fair to assume that from the next year onwards, I mean, growth should be back to maybe what it was. Or do you feel that the cautiousness in the overall scenario can impact another, you can say 6 months or 9 months of growth?
Avinash, you are again on mute.
Okay. Can you hear me?
Yes.
Okay. Okay. So I would not really worry about quarter to quarter and can't predict that in all fairness. What we are seeing is that business demand is a long-term thing, and it is going to continue for years altogether. We are seeing demand coming from all geographies that we are operating in, including India, which is not seen in the past. So and people are willing to pay that kind of rates. So it is a pretty unique situation that we are in, where there's a lot of demand moving forward. And I think we should, as a company, we are fairly placed, and we would want to, make the most of this kind of environment.
Noted, Avinash. Last thing from my side, any color on order book or deal pipeline which you can give versus what it was, let's say 5-6 months back? I mean, I don't want absolute numbers, but maybe directionally, is it much better than what it was 6 months back, both deal pipeline as well as order book?
So it is cautious. I would say 6 months ago, business was falling in our lap without doing anything. And today we are back to the scenario where our sales team has to go out in the market, attend the conferences, meet clients, wine and dine with them, do lead gen efforts, do podcast, all kinds of marketing efforts. So we are back to the normal world pre-pandemic, but the orders are coming. It's not hard to come by. So in pre-pandemic, if the sales cycle was taking 9 to 12 months for a large client, the sales cycle is smaller in the current scenario. But the effort needs to be made now. It's not automatic.
Does that mean the order book and pipeline are better? Or, I didn't get the answer actually.
No, so that's what I'm saying. See, we were getting work automatically. That means it was definitely better. And we didn't have people. Right? So it doesn't really matter in the end. Now we are making efforts to go to the clients and generate more business. And we are getting work. So it is not worse than what it was. But we are making efforts to get the business and we are getting the business. Now, do we have people? The answer is yes. In some pockets we have. And do we need more? The answer is yes, we need more. So in the 6 months ago scenario, we probably had 300 open positions because we were all filled up to the neck. Today we are in a fairly comfortable position and we still have open positions which are probably 100 plus. So, that is how I would like to answer your question, that we still have demand, we still get work, and we are still full in that sense.
Understood, Avinash. That's helpful. That's it from my side, and all the best. Thank you.
Thank you.
Thank you, Archit. The next question comes from the line of Devansh Goenka. You can unmute yourself.
Hi, Avinash. How are you?
Very well, Devansh. Thanks for joining in.
Thank you. Just had a question actually on the certifications that you all have, which is the CMMI Level 3 certification, the Microsoft Gold certification, UI Partner Silver, etc. So, can you highlight if these certifications are points of differentiation when you're trying to target a new client, and what benefits accrue to InfoBeans through these certifications?
No, it is not a differentiation. It is a hygiene factor. You got to have that.
Okay. So it's something which is standardized. It's not something that unique to InfoBeans in that case.
I mean, you need it, but it is not going to make any additional difference. But if you don't have it, it will become a negative.
Understood. Another question I had, if you could highlight, you mentioned 2 projects were stalled. If you could give an indication of an approximate value of what those projects were, are those projects going to be back in the pipeline, or are they cancelled projects, or are they just on hold?
No, it is on hold. It's not cancelled. I would say it is in the range of $2 to $3 million. And it is on hold. They will come back probably in the January quarter.
Understood. And in your earlier slide, you mentioned, if I'm not wrong, that there was revenue visibility of around $40 million. So if you could highlight if that is coming from new client wins or any of your existing clients.
So Devansh, we in the history of InfoBeans for all 22 years, we have been able to generate 90% business from the existing clients.
Okay.
So we hope the same will continue. And with the pace that we are getting new clients, it might reduce a little bit to maybe 85% or so.
So what were the new client wins for last quarter? Generally, all highlighted in a presentation, right? The new client wins. What is it?
Whenever they allow us to put out the names, we will put out the names. Most of the cases they don't allow us, so we avoid that. There are new wins, as I said, but typically what happens is for a line to ramp up to a higher number, it takes some time. And therefore, it is natural that, we acquire a client in one fiscal and the client grows up to the next fiscal, which is where it becomes an existing client.
Understood. But there have been client wins this quarter as well, right? Because earlier you mentioned a number, I believe, in the presentation.
Every quarter we win. And, every year we will have 2-3 Fortune 500 clients. Every year we will have 2 or 3 unicorns, or 2 or 3 billion-dollar revenue companies. So we have been focusing on large names, and we are getting it, across all geographies. So yeah, I think that is one of the big differentiator of InfoBeans, that we are able to strike that kind of relationships with the very, very large names.
That's great. And it's great that you are able to grow the relationship further once you'll acquire a new client.
Yeah, it takes time, right? It takes time to nurture the relationship, but yeah, we are able to do that.
Correct. And sorry, just one last question is your marketing efforts towards growing the Indian business. So earlier, I think we discussed that the Indian business is something you are not aggressively trying to win new clients in. You are still focusing more on the US and maybe the Middle East.
We don't have a sales team in India at all.
Okay. Okay.
So it comes automatically, and if it is within our rates, we will accept it. Otherwise, we will not accept.
Understood. Thank you so much. That's all.
Thank you.
Thank you, Devansh. The next question comes from the line of Shobit Singhal. Shobit, you can unmute yourself.
Hello, sir. Thank you for taking my question.
Yeah, go ahead, Shobit.
First of all, congratulations for the new office in Pune.
Thank you.
And sir, my question is, which is the listed company which is doing same kind of work as InfoBeans in the listed space?
There are so many. If you look at the bigger ones, you have Persistent, you have Happiest Minds, you have. All the IT companies that are there more or less do the same thing.
So, sir, in the mid and small cap, same size company.
Which one? Sonata Software, Sacksoft. Happiest Minds is a small company. Latent View.
Okay.
Yeah.
Thank you. Thank you for taking my question.
Thank you, sir. We have a time check. 5 minutes.
Yeah. So the next question comes from Varun Agarwal. Varun, you can unmute yourself and limit your questions to 2, so we can take all the participants' questions.
Sure, I'll limit to 1. Hi Avinash, I am Ritu. I'm fortunate that I'm the last one to connect. Congratulations for the new office and festive wishes to the entire team.
Same to you, Varun.
And congratulations for the good set of numbers also.
Thank you.
Just wanted to have an idea, looking at the global scenario, compared to earlier, the acquisitions we are looking at, are we getting them at better valuations now, or do we foresee the deals which were on hold by the companies? Are we hoping that they get converted, or the new companies which we are looking at, are they comparatively more attractive in terms of valuations now?
So that is one of the problems Varun we are facing is the sellers have a valuation in mind, which is a peak valuation.
Yeah.
And that is where the reality check is coming in, and a lot of hesitancy in terms of stooping down to a lower value. So that is where the biggest hurdle is. So those term sheets that I talked about, they couldn't accept the fact that the values offered by us is lower than their expected value.
Because of the cautious approach from the client side, that's the same for the entire industry.
It is, yeah. I think the high time is gone, right? The peak time is gone.
Yes.
And
comparatively, will the valuations become more attractive now when we look?
It should, right? It should. When the Amazons of the world and the Googles of the world are falling to half of their values. Yeah. How come an unlisted company, a small company, expect the highest of the valuations? So I think that is where the whole mismatch is. But yeah, I think it's a matter of time. It will happen.
Okay, thank you. All the best for the upcoming quarters.
Thank you, Varun. So the next question is from Chirag Kachadia. Chirag, you can unmute yourself.
Hello. I have a few questions. Is there any plan to merge ourselves with any big Indian name later part of our journey? And second, when you target any entity for acquisition, so what multiple you generally use to pay or prefer to pay?
So Chirag, at this point in time, we are pretty excited about the possibilities of InfoBeans. So we are not willing to sell ourselves or merge with a larger company. We certainly would want to acquire companies on the way. That is our active strategy. Second is, I just lost the second question. What was that?
What multiples?
Multiples. Okay. Multiple is a very case by case situation, Chirag. Typically, if it is a very regular business, then you will not be interested in it. If it is a good business like Salesforce or a ServiceNow business, then it might get anywhere between maybe 5 to 10x of EBITDA or even more. We don't know. So it depends on the quality of the business and the value that we see in terms of the synergies that we can generate. So it's not a very easy answer on what multiple we can offer, but InfoBeans has been conservative in terms of offering the evaluations because we know we have to integrate it, we have to generate the synergies, so there's a lot of investment and cost at our end. Therefore, we can't offer it everything upfront. So we learned of a process where we are saying that half of the value you take today, half of the value you generate over the earnouts. If you are able to generate more value, you get more value. If you're not, then obviously not. So that kind of mechanism we have created, and touch wood, it has worked in the last 2 cases. So hoping it will continue for us also in future.
Thank you.
Thank you, Chirag. The next question is from the Hetal Sonpal. Hetal, you can go ahead.
Yeah, hi Avinash, how are you doing?
Hi Hetal, very well. Good to see you.
Even makes you look like younger.
I'm trying to beat you.
Okay, 2 questions. One is nothing was talked about the golden word in the IT industry, moonlighting, which I'm very surprised. And second thing, doesn't opening a new center put more pressure on the bottom line and thus impact the margins further? Or maybe I don't know the maths here.
No, it does. So I'll answer the last question first. Definitely is counterintuitive. When people are talking about remote working, hybrid working, why are we investing in a new facility? I think we have a contra view here. We want to have people coming to the office, and we want people to work with each other. It irons out so many unspoken issues, and it creates a very strong bond for future, which is what we are as a company all about. As a company, we believe in investing in relationships, and I keep telling that if you look at our top 10 customers, the tenure is 7+ years. If you look at the top leadership team, they've been with us for decades altogether. So that is not possible if you work remotely, right? You can't ask about your family or kids on a Zoom call, right? It has to be over a cup of coffee or a tea or over lunch, which is fairly possible in an environment, in an office environment. So the strategy that we are following is we are creating smaller offices. Let's say Pune is a large city, so now we have 2 offices in the 2 ends of the cities. We have also gone to Vadodara in last quarter, which is a tier 3 city. So we are saying that we want people to come to office, and if you can't come to office, we'll go to you. So that is how we are trying to come closer to our team and bringing them to the office so that they also get energized meeting and greeting people every other day. They don't have to come all 5 days of the week. They can come, let's say, 3 days of the week. At least start to build that relationship. That's the first thing. The other thing that you talked about was moonlighting. We have contracts which are clearly talking about dual employment, and it is not allowed at InfoBeans. Now we are also taking a clue from what other companies are trying to do, like Infosys and TCS. And they're saying that we are willing to allow side gigs as long as it is informed and it is not in the creating any conflict of interest. So I think it is a good sign and probably will be willing to adopt that kind of a model where we want people to do any side gig, which is not in the conflicting with the current work. It allows them to, focus on their 8 hours of job, 9 hours of job they're doing. But at the same time, it allows them to learn new skills or, explore new possibilities and, maybe make some money out of it. So we are totally fine with that as a model. But dual employment is a clear no.
So good point. So quickly on a counterpoint, this might be a good R&D study. Maybe might ask Siddharth to get some people in. I'm in there to do it on the impact on productivity on working from office versus working from home. I think it's been a time now, and I think across organization might be good to find out whether there is actually a real fact behind it.
That is definitely a good study, and I have an experience of productivity tools. Sapiens was one company that we invested in, and very startling facts around office productivity. And my worry is that home productivity is further low because our homes are not set up like that. We just created a jugaad of working from home. It is disturbing a lot of personal lives. It is disturbing, relationships. Plus, it is not really appropriate many times from an infrastructure point of view, from the presentability point of view, just from the discipline point of view. So yes, there are both sides of views. As long as people have separate, infrastructure and ability to manage that. As I said, I'll be happy to, promote that. Plus, cities like Indore, you can, or Vadodara, or even Pune, if you are close to that office area, 20 minutes to an office is a fairly okay deal. But if it is 1 hour or 2 hours, I would certainly not want to go to office. I agree with that. So companies have to figure out innovative ways to handle that kind of a situation when they do the best of both worlds.
Got it. Thanks, yeah. Good luck for the next
one. Thank you very much.
Thank you.
I think we are over time.
Yeah, this was the last question. You can continue the meeting. Yeah.
Thank you, everybody. Appreciate your support all this while, and be rest assured, we as a company want to focus on growth, and we are investing. You can see the results coming up in that manner, and we'll continue to do that. Both organic and inorganic, goes hand in hand for us, and we are painfully aware of the cost pressures, and we are taking measures to, handle it. But it's going to catch up over a period of time. Good news is that we are able to, work on the single objective, and we're able to deliver on the revenue growth, which we have been able to do that fairly well. So thank you very much. We appreciate your support all this while.
Thank you, everyone, and we are concluding this call now. Thanks for joining. Thank you.
The recording